All right. Hello, everybody. My name is Michael Duke, and welcome to my channel. This is the channel where I talk about stocks that are interesting. So if you find that interesting, then please consider liking this video and subscribing. Today, we're going to be talking about stock that has ownership of some very iconic brands, likely one that you've heard of, not just in the United States, but if you're watching from overseas. The Del Monte brand is known internationally. Very, very interesting business story. As I do in every video, I'm going to give an overview of the company. We're going to discuss the investment thesis, why it may or may not be interesting. We're going to take a look at the numbers, especially in their most recent earnings report here. We're going to take a look at the valuation and the dividend and discuss some of the risk factors, as well as do some technical analysis before we conclude with a grade: buy, sell, or hold. As always, this is not a recommendation to buy or sell a particular stock, just my opinion. One thing I want to address before I get into it is that it has been a while since I've made a video. I think the last video I made, I posted in October, and frankly, I've been really busy with some of my other projects, most notably my ranch, and then also I started a new venture with a partner. I started a new getting back into venture with a partner. Value getting back into commercial real estate. So I've been busy with all of that. Commercial real estate. Things have finally settled. So I've been busy with all of that. I've got more time. Things have finally settled. Take a look at more stocks. I've got more time to. So, without further ado, let's get into it. So, the stock we're talking about, Fresh Del Monte Produce Inc. Fresh Del Monte Produce Inc. Ticker FDP. Very, very interesting. They released earnings about 10 days ago. And you see here, this stock it's been a pretty tepid performer the last 10 years. But recently, starting about 2 years ago, it's been on quite the tear. It's up. It was about 100% from lows in July 2024 into the last few months. On the most recent earnings report, it's sold off quite a bit, as we see here. From $41, now it's hovering right around 33. So I've been watching this one for a long time, but recently with the sell-off, full disclosure, I felt that it was an interesting entry point. So I did pick up a small allocation to it. And hold on, I'm getting an important text. Sorry about that. So what was I saying? Oh, felt that the recent sell-off was a compelling time to take another look at it. And it's been a while since I'd really gone in depth. The recent sell-off again had never bought shares before. To take another look at it. And really been a while since I'd really gone in depth with it. Came out again. Had never bought shares before, but recently took a look. We'll dive into that here in a second. Some really interesting news. Let's talk about the story. So Fresh Del Monte Produce, of course, you have that iconic Del Monte brand that started. I don't think it's in this YouTube page, but I'm pretty sure maybe it's in this one. Yeah, right here. So Del Monte kind of has this genesis in the late 1800s here in the fruit belt of California, and basically became a conglomerate by picking up more of these, like it says here, Oakland, California foods distributor used the Del Monte name to market a premium blend of coffee that we've been prepared for the hotel. The Hotel Del Monte is the namesake of the brand. By 1892, the firm expanded its business and selected Del Monte as the brand name for its new line of canned peaches. It introduced the Del Monte Shield in 1909. So this is a company, and really, I should say brand, it's been around for a while. Again, very notable, very, very notable, particularly in the United States. Whether that's fresh fruit or packaged fruit. Up until this quarter, this most recent quarter that they reported on, those two lines of business were two separate companies. And that started in 1989 when RJR Nabisco sold the fresh fruit division of Del Monte Foods to Polly Peck, which don't really know a whole lot about that. But basically my understanding is that it's, there was at one point in time, Del Monte was a conglomerate that had the fresh and the canned foods business that got split out. And Fresh Del Monte Produce has been the fresh fruit arm of that. Well, in January, the Fresh Del Monte Produce, again, trading under this ticker for a long time, it's been trading on that as that ticker, since the late 90s or maybe even sooner, but late 90s in there. Del Monte Foods is the canned business. Okay. And we were just looking at that. Del Monte Foods is the canned business. So here, headquartered in Walnut Creek, that's close to where I'm at now, subsidiary of Nutra Asia until recently. You see, if you look into this, I'd urge I'm really struggling to articulate this well because I haven't read it super intensely. I've just kind of scanned through. But what's interesting is on July 1st, 2025, the Del Monte Foods, again, the canned, the non-fresh foods, the canned and the, in jars like the peaches and stuff that you're probably used to seeing, was in Chapter 11 bankruptcy and went into a bidding process. And Fresh Del Monte Produce was able to buy it for 285 million gross. I think that ended up being more than 300 million after working capital adjustment. Section 363, I was reading about this earlier. That means that the buyer of the business is not taking on the certain liabilities that it has, like pensions and stuff. So pretty favorable deal in that regard. So anyways, that was kind of a long-winded way to say that Fresh Del Monte Produce historically has been just that fresh fruit business. And with this new acquisition has brought the packaged food business back into the same umbrella. And that's super interesting to me because obviously there's synergy there. Fresh Del Monte Produce has a logistics network that it uses to, fulfill its supply to the marketplace, to the end buyers. And so there's lots of synergy there among the two entities. And the price that they paid for it, was, I was doing some analysis of this earlier. Let me just pull it up real quick. Yeah, 308 million after working capital adjustments. But the revenue, and maybe we'll find this in the reports when we look at them. The revenue of Del Monte Foods, 600 million. So they're getting it at half, less than one time revenue. In fact, half times revenue, which, we'll see some insight into their, profit or lack thereof. It's not really, we're not looking at that as a profit on or a multiple on profit, but a multiple of revenue. Seems like a pretty good deal, especially considering the synergies there. So that's super interesting. But anyways, forget about numbers for a second. I think it's a very interesting story that they were able to pull in the foods, the packaged foods business again, and that's just an interesting and juicy story to me. So let's move this over to here and let's take a look at their most recent earnings report. Again, this is May 5th. Today's May 18th that we're taking a look. Okay, so highlights. Del Monte Foods acquisition closed, uniting brand and platform. We reached a major milestone with the closing of the Del Monte Foods transaction, reuniting the brand under a single owner for the first time in nearly 40 years. Early performance has been encouraging and reinforces our confidence in the opportunity. Bringing the brand, portfolio, and platform together to strengthen our position across the store with synergy, shaping a more focused, higher quality portfolio over time, and proven operating model in a challenging cost environment. Higher agricultural input costs tied to Middle East war in first quarter will continue to have a ripple effect for months to come, regardless of how the situation unfolds. So, there they disclose a headwind that we, must acknowledge in our risk factors. But let's take a look at the financial result. 1 billion of sales, lower per unit selling prices in the avocado product line due to industry-wide oversupply, partially offset by the acquisition. So lower net sales, cost pressures across poultry and meat, prepared foods and logistics, partially offset by pricing strength in Del Monte Foods acquisition. Gross margin 8.5%, and then they've got some adjustments here that they give some footnotes to. So right off the bat, we're seeing that they have pretty low margins. I mean, that's got to be one of the lowest gross margins of something that I've looked at. And then their net margin here, $40 million. So again, we're talking about less than 5% net margins on adjusted operating income. If I had to, maybe this will become more clear, but it probably should be pretty obvious at this point. This company is vertically integrated. They've got, they're producing here. Hold on. Sorry. I gotta respond to this real quick. Sorry about that. So when we're looking at this company, margins are obviously very low. And what I was saying before I got distracted was that farming, producing the fruit, that's an inherently low margin business. We all know this. And they've got the integration above that, which allows them to capture, more and more of the value chain. So I'll be interested to maybe we should take a look at their margins when we look at their financials. But that's interesting. Again, we can look at it over time, the trends and all that, but very low margins. So in the quarter, net sales, this is for fresh and value added product. Lower net sales from fresh and fresh cut vegetable product lines due to divestiture, portfolio acquisition. Oh, I see. We're going from here. So sales decline here more than 10%. Gross profit went up in the segment. You see that they divested out of man packing. I don't know a whole lot about man packing, but that's interesting. So gross margins went up, adjusted gross margin. So they actually have a little bit higher margins in the overall segment there. Okay, so bananas, we know that they're a big banana supplier. Net sales, 357 million. Again, that was lower than the prior year quarter. Lower sales volume in Asia, lower North America volume from soft demand, higher per unit selling prices, and favorable foreign exchange impacts. Excuse me. So we see here gross margins less than 5%, roughly 5% on an adjusted basis, but also lower. So, you take that into account here, you see how, the value added products versus banana are lower, right? They already had some prepared food brands, it appears, but they got a lift there due to the acquisition. Closed late March 2026. So does it say for when the quarter ended here? I would assume it ended, the end of March. So we're talking about a very, very small amount of accretion through this line item, but still had value there. Higher per unit production and distribution costs pressured margins on a gross profit basis. So that's, completely inverted. We had higher revenue and lower gross profit. So significantly lower margins, it appears. I can't do that math in my head. Well, this is roughly 13%. And then here we've got 10.8%. Perhaps I can't do it in my head. I shouldn't overestimate myself, or underestimate rather. Similar story here. Other products and services. So they actually have a third-party freight business. We see this as they have poultry and meats as well. So these are, a smaller segment here. And significant cost pressure, it appears here. Higher revenue, 33% lower gross profits. Adjusted leverage ratio, that's pretty low. That's pretty good. They pay a good dividend and, buy back shares. They got 4 million authorized to buy back. Their market cap, 1.5 billion. So, that's 2.5, 3. No. That's less than 1% of the market cap. That's like 0.2%, I think, if I'm doing it right, of the market cap. So those buybacks really aren't significantly moving the needle in terms of, reducing the share count, but, it's not nothing. We're not going to look at that. Well, do we have, just doing a real quick visual scan here. It's kind of hard to treat out what the true impact of the acquisition numbers. I would just say that it's non-material probably for this quarter. So let's just back up a second on this. I don't really care too much to go into those financial statements at the bottom just because I want to zoom out a little bit. I want to zoom out, and we'll do that in a moment. Let's talk about the thesis for why this company is interesting. We already touched on it a little bit earlier. The this company has had a pretty good run of performance the last 2 years, which we touched on. Let's take a look at their financials. They've had a really good couple of years, and just because they've I would imagine that that has to do with this a legacy business. They're in a market that's highly commoditized, so they don't really have a ton of pricing power. However, they do have the Del Monte brand, so there's more than some of their competitors there. But either way, they're in a low margin business that's based on volume, and they're able to achieve higher margins than their competitors because of integration. So right then and there, if you're looking for exposure to consumer staples and particularly really to agriculture, I think that that's just inherent to the thesis with this company. That it's, I don't have a list of all the fruit producer stocks in front of me, but I would imagine that this one is in terms of quality in the upper tier just because of its structure, top percentile level of structure, just given the integration. So when times get hard, there's a lot of inflation. They're pressured in terms of their cost pressures. Consumers are also pressured, and this company is able to compete a little bit better on price. Therefore, leveraging or able to leverage strong market share there. So that's inherent to the thesis. But I think the main catalyst here as to why it's particularly interesting right now is the recent sell off, what appears to be a good valuation, which we'll take a look at in a second, and the Del Monte Foods acquisition, right? Because again, what we're seeing here, if we just go back here and we look, $1 billion of net sales, $1 billion of net sales, right? Before the acquisition. Now, we had like a week or two of that, new company in here. I don't know how long, but recorded to it. But we're talking about revenue increasing by 60%, right? Through that acquisition alone. Revenue's increasing by 60%. Their market cap right now, 1.5 billion. They didn't issue any equity to perform the acquisition. They used a combination of cash and a revolving debt facility. So they did, they're using they used leverage to close the acquisition. However, they didn't dilute existing shareholders, which that's relevant when we're talking about the market cap. So again, they paid 300 million market cap. That's today's market cap. That's roughly 20%. Today's market cap, increasing revenue by 60%. Or sorry, no, that's not right because this is on a quarterly basis. So 4 billion, if you annualize that, 600 is what, 15%. So they're increasing revenue by 15%. Sorry, honest mistake. That's interesting. Now, whether we can treat out if there's some sort of arbitrage opportunity in the revenue versus margins of the acquired business, perhaps we can find that when we look at their earnings call. For the sake of time, we'll attempt to do that if we get through everything else in an orderly fashion. So we see here revenues have modestly trended up over 10 years from 4 million in 2016, or excuse me, 4 billion to in the trailing 12, 4.3 rounding up. So that's pretty low growth, right? Like that's not super great. That's not even 1% per year. Gross profit, some sort of anomaly here where we see, in 2016, how, gross profit, 461 million. And by 2018, that had declined all the way from 286 million. Now, off of those down years here, where we kind of declined and we see we bottomed in 2021, 250 or so, trend line has been very strong. So despite revenues remaining pretty much flat from 2021 to the last 12 months, margins have gotten a lot better. And I think that that's been a real driver of the stock price. So we see here, gross profits have increased roughly 30% over that time. So I think the market's given them a lot of credit for this perceived operating leverage that they have. Again, it was like around this time that their gross profits were really bottoming. Market didn't really catch on, kind of went in nowhere's land. And then again, about 2 years ago, it really started to look a lot more bullish. And then we've just been knocked right off that trend line. Operating income shows pretty much identical result there, where you had phenomenally low operating income, 50 million for the whole year, and we've tripled operating income. So whatever they've done in the last 5 years, 4 or 5 years, has really made meaningful results in their financials. Share count has slowly gotten reduced as they've started buying back shares. I mean, in a lot of ways, that's probably what's driven more confidence in the stock, is that they've just been, harvesting profits, pay dividends, and buy back shares as a mature business should. And we see here they, were raising the dividend to here. They cut it to conserve cash, and then they've been aggressively growing the dividend again. And in terms of payout ratio, it's remained, pretty low the whole time. But we're just looking at a legacy business that perhaps had too high of a dividend. They continue to raise. We see this all the time. And perhaps new management came in and kind of salvaged that. Overall, looking at these numbers, I'm definitely curious as to what changed around this time, and frankly, I probably should have done research before making this video, but this is kind of like a live reaction video here that I'm looking at it. Something changed about 5 years ago that allowed the management team to, be more effective, whatever they were doing, whatever strategy they changed or measures they put in place. And so I'm pretty underwhelmed by the financial results over the 10 years. However, encouraged by what we see in the last 5. And maybe that's something that we investigate a little bit later on. Have they been paying down debt? And of course, the recent, capital outlay to perform on this new acquisition it's not reflected in here. Speaking of which, we need to look at the balance sheet. So, we've got 66 million of cash, as of the last report. Don't know if that's, yeah, okay, so we do have it. So 66 million of cash in the last report. Hasn't really been trending in any direction in particular on a quarterly basis, but we do see a modest uptrend here in cash. So kind of a steady updrift of current assets, which is good. 1.4 of current asset and 1.4 of net property versus 588 of current liabilities. And that hasn't been trending up over the last 5 years. That looks healthy. And now we see here, they've been aggressively paying down long-term debt here. So that's what they did. So that kind of gives us a little bit more insight into what's been going on. They cut the dividend. We know they cut the dividend around this period, and they started aggressively paying down debt. And so that's what's been driving gains in the share price, along with the underlying business performance. So again, 1.4 of current assets versus 1.4 billion of total liabilities. That's pretty healthy. Again, they don't really have a ton of cash, and we know that their current short-term debt. Do we see that in here? Yeah, see, I don't see like a revolving facility in this part. It'll be interesting to treat out, the details on the actual debt that they use, and how that shows up on their balance sheet here. Doesn't really look like there's a great category within Seeking Alpha in terms of their balance sheet. But overall, I think the balance sheet looks pretty healthy. And perhaps that's what allowed them to compete and bid and win this last acquisition, that they had a little bit more dry powder to play with because they paid down their leverage significantly the last few years. So overall, I think the income statement somewhat underwhelming. However, there were some clues there. The balance sheet kind of further gave us more clues into how they've been going about that. And that gives us, I think their balance sheet looks solid. It's not amazing, but it's solid. One thing that is interesting here, book value per share right now, $42. We know that that's significantly above their current share price. So that's a good indicator of value right there. The fact that it's trading below book value. Um, and again, market cap of 1.5 billion, current assets versus current liability. There's about a $800 million spread of current equity. I'll call it. I'm making up that metric that they have, and then also our total assets, total liabilities. So that's how they're trading. You know, below book value. So we're not looking at a business that is in financial pressure here. So overall, the balance sheet looks really good, I think. And that kind of segues us into looking at the valuation because again, price book looks really good. And this is a company that owns a logistics network. So conceivably there's real estate there, there's trucks, there's infrastructure, there's farmland that they have, there's farmland there. And in fact, let's look at their gross property, plant, and equipment, right? Not in the last report, at least flowing through here, but net of depreciation, we got 1.4 billion of property, right? And so that's another. While we're at it, addition to the thesis here, I think that makes it interesting is that we're sitting on an asset rich business that controls a lot of the value chain in the products that it's selling, even more particularly so with this recent acquisition that they made. So I want to see a business like that owns a lot of property trade below book value to feel like it's a good deal, and that's what we're seeing. That's what we're seeing. And again, book value is based on the cost of the assets minus appreciation, right? So that can depress the book value. However, if the underlying properties have appreciated, of course, they're not marking that to market. So we know that book value isn't a perfect measure of what they're really worth. However, it's always encouraging to see that. So less than 1 times book, that's great. On a forward basis, I'm not sure if Seeking Alpha is taking into account, it doesn't look like it, taking into account the price sales of the new entity, but we know price sales in the trailing 12, well, that didn't incorporate our acquisition, and we're trading less than half times sales. So again, sales are 4 billion, they're 4.6 now, rounding up. So if we just divide 1.5 divided by 4.6, well, yeah, that's 0.33. So that's appears to incorporate the acquisition. So that's incredibly low. It's also not a super good metric when we're looking at these lower margin volume businesses. So I don't want to put too much stake in that, but obviously that's a low price sales ratio and just further adds to the perceived value that we have here. So in terms of the price earnings ratio, we see, trailing, we're at a 10, forward, we're at 15. That indicates that there's integration costs flowing through to earnings that are, skewing that down. A 10 multiple on the business the way it was before is cheap, right? All the enterprise value ratios fairly low, and then this price cash flow on a backward looking basis incredibly low. We're talking, strong double digit yields on cash flow. So all in all, the valuation looks really good. I think if we look at it in yield terms, let's just take a look at the dividend yield. Dividend yield right now, trading in the high 3%, almost 4%. That's not the highest it's been in the last few years, but it's pretty close. So in terms of just raw cash yield, it appears to be attractively valued relative to history. And we know that they've cut the dividend. Like here, it traded down, they cut the dividend, and we got, really low, but they've aggressively raised. So in terms of a yield, just pure cash yield on your shares, I think that just looks relatively attractive if you take it at face value. In terms of our, like I was saying earlier, double digit earnings yield, free cash flow yield on a trailing 12, also double digits, very attractive. Free cash flow yield in the go forward, not so much. And so I think that that probably has to do with the acquisitive activity. And perhaps we can find some sort of article or something on here that maybe illuminates that a little bit more. But yeah, I think in yield terms and in ratio terms, our valuation looks pretty good here. Seems like a good value for sure. Seeking Alpha definitely agrees, says that it's at an A minus overall. I don't know if I'd go that far, but yeah, valuation appears to be strong here. Now, one thing that's interesting is, we're showing a good growth score here, and I think we need to take a look at the insights article here from Seeking Alpha. So their management's forecasting 13 to 15% net sales growth as Del Monte Foods at 600 million. So that's our 15% accretion through the acquisition amid additional cost pressures. So we're buying revenue, but we're also buying a business out of bankruptcy that was struggling. Now, the reason it was in bankruptcy was it had too much debt. That's been discharged. So we're getting a much cleaner entity operation than under prior ownership. And we see here 2026 net sales. They're expected to increase between 13 and 15% year over year. And that includes 9 months of contribution from the acquisition. So that's not purely from M&A. There's some organic growth in there too. Those cost pressures aren't from the acquisition, they're from the cost headwinds tied to the Middle East, citing ocean freight costs, including bunker fuel and war-related surcharges and fertilizer and packaging costs. So, of course, because they are an end producer of food, they are, subject to the cost pressures of fuel and fertilizer, which I've talked about this before when looking at Corteva, looking at Nutrien, a couple other businesses that, in a regime of inflation, that commodity stocks, kind of the apex of the value chain, meaning oil and the next step down from that being fertilizers, that those costs tend to explode. Those producers and providers end up seeing expanding margins. Initially, that squeezes the agricultural producers. However, in a full-on commodity inflation regime, they end up catching up because as a result of those increased cost pressures, the prices of all of the commodities also increase. So kind of a complicated relationship between agriculture and inflation, but this company is impacted and also a potential beneficiary at the end of that regime. So I think we've got enough now to kind of migrate into risks. This is pretty straightforward. I think in terms of your like valuation risk, this is not that type of stock. You're not buying an expensive compounder that's priced for perfection, that despite its quality probably ends up doing well over time. You're just buying it at not a great price. That's not what we're looking at here. I think that your risk if you are to enter here or close to here, or you're just holding on to your shares you already have, I don't, I think we're at a value here that can be justified in terms of either buying or continuing to hold. So that's not really a risk factor, the price, which it is with a lot of the companies that I've covered in the past. Really, our risks here are, fairly cut and dry. You've got really what management was talking about in that earnings call, where they're exposed to the cost pressures of the war, just really meaning energy prices and how that filters through their value chain. Now, one thing that mitigates that risk somewhat is the fact that all of their competitors, who may or may not be integrated like they are subject to the same risks. And therefore, the fact that this company has that integration actually puts them in a more advantageous position. So while those headwinds do filter through the income statement, this business is conceivably better positioned to ride out that storm. So really, yeah, we see that this company is exposed to energy inflation, fertilizer inflation, all of the things in inflation that end up, being kind of the boogeymen that, crimp them out. However, again, they're asset rich in terms of the land, in terms of all of their hard assets. Those are a buoy to them. So yeah, risk factors are just their margins being pressured under inflationary regime, which if you have been looking at the oil price, you could easily see how that would cause the share price to have declined here on this earnings report. I think another risk that we have to be cognizant and aware of is the integration risk of them, taking this pretty large bolt-on acquisition and integrating it. Now, again, I would think that the integration risk here is a little bit more benign, given that both of it's effectively the same brand, right? And so it's kind of a layup in terms of cultural fit on the surface in an outward facing way to customers. Customers should probably be pretty stoked about this. So I wouldn't think that there'd be a lot of attrition or something like that. We don't, but there's always integration risk internally to the culture of any business. So we always have to be aware of, when there's acquisitions, how that could, depress margins and put pressure on the overall entity. And I don't really, I get spooked all the time when businesses make acquisitions or they announce a reverse merger like McCormick did with Unilever a few months ago. I really didn't like that, but that's an aside because that just doesn't, that seems like a downgrade. But anyways, in terms of risk factors, yeah, I think commodity inflation, we're sensitive to that, and we can benefit from it as well, just given the asset base and the underlying products. However, we are in more of a low margin commodity business, so that's a headwind for sure. And then we also have integration risk. But in terms of where the shares are now, I think, some of that has been baked in, and the acquisition just, it creates, because the acquisition didn't have numbers that really flowed into the earnings report. I think the timing was a little poor. That might have been a reason that it sold off really hard. The market just isn't sure how to value the new entity. And I think that's something that will resolve by the next earnings report to come in, August or whenever it is, 3 months from now. So I think that that's really interesting that we're in kind of that setup. So let's move on to a technical analysis. And whoops, I do that from move me over here. So again, I'm going to kind of go from the current trend line, which is right here. And it's been a little bit since I've done this. So let me move myself up here. So again, this is kind of our uptrend, more or less. It's not perfect. Obviously, we gapped up above that, came back down. But stock's been riding this trend again since it bottomed in July 2024. Just been riding, staying within the pocket. Real nice. You see here it consolidated. It consolidated here right before earnings, and then we've just sold right through that trend line. And, as for where we might find a bottom, well, if you kind of, again, people who are serious technical analysis nerds probably get irritated at my channel because I'm so basic. But there are kind of a couple different levels here, price levels. We fell right through this one. We fell right through this one here. I don't have the line there, but we fell right through that. And now we're right now, market's almost closed today on May 18th, but we've basically fallen all the way to where we're, bouncing right here. I shouldn't say we're bouncing. We're still selling off. Today, the stock is green. However, we should take note of that. Stock is green today. Whether that's a dead cat bounce off this line or not, time will tell. But yeah, anytime a stock just sells right through a trend line like this, to be really convinced that it's going to bottom, which I don't like to try and time that stuff. That's just not my style. I'm not smart enough to figure that kind of stuff out. But what I have noticed is that it's pretty tough to predict when something's going to bottom once it falls out of a trend. It has to find new footing, and potentially it's there now. It's definitely at a prior level of both support and resistance of the prior trend. That certainly was, there was a junction here where it continued up. But, this is undeniably sold right through the floor. So technically speaking, in my opinion, the chart is a little shaky right here. Like it's not like a fist pounding or table pounding with your fist, no brainer here, technically speaking, when looking at the chart. But Um, the fact that we've broken through the trend line when all the underlying business results, they weren't great. I mean, I see why the market sold off on those numbers. Like they didn't look very good. You had significant, margin erosion in that quarter. The market really didn't like that. And then this acquisition, I think, is really going to take the entire next quarter to resolve. So I think this stock will probably be pretty volatile over the next quarter, and it might continue to find new lows. It might bounce back from here, but it's certainly not going to find, I would imagine that it's not going to find its way back into this uptrend just right off the bat. Like it might bounce here and it might bounce, between these two lines here. That seems realistic to me before finding new footing and getting back into an uptrend. But overall, just moving on to my grade, I do think that it's a buy because I think that right now there's just enough uncertainty between the earnings results and the lack of, meaningful attribution in those numbers for the market to have just gotten totally spooked. And yeah, their numbers weren't great. So it's not like it's not something that we look at and be like, oh man, like this is a no brainer. It's not a no brainer. Nothing is really in this world, but it's certainly a lot cheaper than it was before earnings. And in my opinion, it's a better business because of this possibility that they could just go gangbusters on this acquisition. Now, I will say with the acquisition, the packaged food category, that's a legacy business that's struggling right now, all across any of the stocks you look at. So um, that's yeah. I mean, maybe the market just didn't like that they were getting back into a segment that maybe isn't as good versus the store bought brands. But ultimately, I think that it's compelling. So my grade is that it's a buy. I wouldn't say it's a strong buy because there's uncertainty, but I think it's worth taking a flyer here. Again, I'm not recommending that you do anything. Always do your own research. Always understand your own risk tolerance and profiles before making an investment. You know, buying stocks after they sell off like this, what I've found is in the short term, that produces poor results. So if you're trying to beat the market every single day or every single week or month and always watching your benchmark, I would urge you to not buy stocks like this that have not found a floor that's confirmed yes or no. But for me and my risk tolerance, the valuation that it's at, the yield is about 100 basis points below the 10-year treasury, less than 100 basis points below. So I think that's pretty compelling. There hasn't been much dividend growth. It was significant 2021, they were paying 10 cents a share, growing all the way to 30 cents a share, but they haven't raised the dividend recently. And so I think that the fact they haven't raised it recently off of this kind of backdrop of really strong growth combined with these recent financial results and uncertainty around the acquisition, it's creating a profile of just enough uncertainty where there's a sell-off and a potential opportunity. But when I look at the uncertainty, it's nothing that kind of spooks me out in terms of the thing. So I graded a buy. I think that the opportunity is compelling enough to start building a position. That's what I've done. But again, this is as of today probably one of the, if not the smallest positions I have in my portfolio because it's new. And again, that's what I mean when I say taking a flyer. This isn't something that I would put 10% of my portfolio into right now because there's just not that much certainty about it. So anyways, that'll conclude our video today. Again, this is my first video in, gosh, 9 months. So I felt like I was a little rusty. Maybe you got that impression, maybe you didn't, but it's okay. I always have a good time doing this. I learn a lot more about my work as I kind of articulate these things out loud. So I'm just grateful for the opportunity and ability to do that. And I'm just, if you've been watching my channel for a while, you've been wondering where I'm at, I'm back. I like to come and go. You probably noticed that. But yeah, hopefully you found this insightful, interesting, and compelling. If you have, leave a comment, interact with me. I try to be really good about interacting and responding, and I can always be better. So give me a reason to be better. So like the video, comment, subscribe. If you found this interesting, give me some feedback, and I'm always taking submissions over stocks to take a look at. So if you got one that you want me to take a look at, please feel free to give me a suggestion. But anyways, it's been good, it's been real, and hope to see you guys again soon. All right, thank you for watching, and I'll talk to you later. Bye.